Hello YouTube, how goes it? My name is Abhilash and welcome to Credit Debit with Abhi. In today's video, we are going to be diving into credit score and the components that make up your credit score. We are going to be focusing specifically on the FICO credit score. We're going to dive into nuances of how to optimize your credit score and also dispel some of the fallacies that are out there about credit score and what impacts it. Like we do in all of our videos, without further delay, let's dive in. There are 5 components to your FICO credit score. The first one is the payment history, which constitutes 35% of your credit score. This is the largest. The second component is the amount that you owe, or what is known in common parlance as credit utilization. The third component is the length of the credit history, and this constitutes 15% of your credit score. The fourth component is the credit mix, and this makes up 10% of your credit score. And the last component is new credit, which makes up another 10% of your credit score. Now let's take the time to dive into each of them and understand this in a little more detail. Let's talk about the first component, which is your payment history. As I said, this constitutes about 35% of your credit score and is probably the most important thing to focus on. If I look at the realm of credit cards as a means of impacting your credit score, it is important that you're paying off your credit card dues in full and on time to positively impact your credit score. Every time you pay off your credit cards in full and on time, you can think of that impacting your credit score in terms of small incremental lifts. Now, the next question that might come to you is, what happens if I miss my payments? Generally, a missed payment will stay on your credit score for up to a period of 7 years and definitely negatively impacts your credit score. Now, one missed payment won't necessarily completely ruin your credit score, but I think it is very, very important to stay on top of this and keep this at 100%. Now, I know I spoke about credit cards as the first example, but this holds true for any other line of credit that you might have. Your home mortgage might be another example of where you need to stay on top of your payment and not miss your payments. Technically, the closer you are to 100%, the better it is for your credit score. I'm a little obsessive about my credit cards, so I keep on checking my different accounts pretty much on a daily basis to see what the outstanding amount is. Now, for you, this is not required in the least bit. Just aim to pay off your balance in full and on time before the due date. I'd recommend just enroll in autopay, and this will take care of everything for you. I would also stay clear of making partial payments towards your due amount because it starts to accrue interest, which are astronomical in some of these credit cards. You can be paying up to 23-24% annual rates for some of these credit cards, which is just obnoxious. Think about your credit cards like they are debit cards, meaning when you spend it, you have to pay for it. If you keep a tab on this, it'll be a great starting point and a great foundation for building strong credit score and strong credit history. I'll also take an example to substantiate the point. If you have a credit score in the range of, let's say, 780, for Credit Karma, if you miss one payment, if there is one late payment on, let's say, your credit card, that can bring your score down from 780 to somewhere in the region of 670 to 690. Now you start to see the huge impact that a missed payment can have on your credit score. And obviously, the more recent the missed payment, the larger the impact on your credit score. Other things like bankruptcy can also have a very massive impact on your credit score. So again, to reiterate, this is 35% of your credit score, so please stay on top of your payments and make sure you're making them in full and on time. Let's move on to the next one. Let's move on to point number 2, which is the amount that you owe or your credit utilization. There are quite a few nuances here, so let's dive into a few of them. Number 1, the denominator of your credit utilization is the aggregate of all the credit that is available to you. So if you have 5 credit cards and each of those credit cards has a credit line of $10,000, your aggregate denominator credit available is $50,000. Now, while credit utilization can be thought of as a simple division of the numerator, which is the amount of credit you're using out of the $50,000 in our example, but it's a little more complicated than that. I look at it in 2 segments. Number 1, each of those individual credit cards also has a credit utilization element to it. So think about it. If you have 5 credit cards, each of them with a $10,000 credit line, each credit card can also have a credit utilization factor. So your first credit card, which has $10,000 on it, let's say you've used $100 of the $10,000 credit available on that credit card, and that's the number that gets reported to the bureaus. Then your credit utilization is 100 divided by 10,000, so about 1% on that credit card. Now that is important, but so is the average credit utilization across all of those 5 credit cards. Let's assume that you don't have any utilization on 4 of the 5 credit cards that you have, then on the 5th credit card, you have an utilization of $5,000 on the $10,000 credit limit. So at an aggregate level, your overall utilization comes out to $5,000 on the numerator and the $50,000 in the denominator. So your utilization is close to about 10%, which isn't bad, and we'll come to what good looks like. But for that specific credit card, your utilization is 50%. So this might impact your credit score negatively. If you have to have the $5,000 as utilization, you're better off distributing that evenly across these 5 accounts, $1,000 each, versus keeping all of it on one credit card. Now, I'm not recommending that you carry any balance on your credit cards, but what I'm saying is, if there is an amount that has to be reported, it better be distributed across. If amount has to be reported to the credit bureaus, you're better off having it distributed across these credit cards than for one credit card to take the brunt of the utilization. Let me know in the comments below if that made sense. Now, what does good look like here? In a lot of the literature that you would read online, you will see that recommendation is to keep the credit utilization below 30%, but I'd recommend that threshold is very, very high. Instead, my recommendation is definitely keep it below 10% and as close as possible to 0. If we take the example of just credit cards, your statement closing date is when generally your bank or your financial institution is going to report to the credit bureaus. As long as on that date, you're not carrying a huge balance against the credit available to you on that particular credit card, you should be fine. Moving on. So your credit utilization was 30% of your credit score. Moving on to the next item, which is number 3, the length of your credit history. And this constitutes about 15% of your credit score. And this is generally the average age of all the accounts that you have open. The inference to make there is twofold. First, the line of credit that you open right at the top of your financial journey is going to be very important. For example, the first credit card that you open will be a big factor in what your average age of account opening is. For example, if the first account that you open is a credit card, that is going to be hugely contributing to the average age of your credit history. And so if you're thinking about having a very diverse credit card strategy, I would say when you begin your credit card journey, especially if you're not looking at borrowing for a home loan right off the bat, I'd recommend applying for a credit card with a consistent frequency when you start off is actually a very good strategy, because as you start moving towards the mid to the tail end of your credit card journey, adding a new credit card actually doesn't impact your average credit age as much. I'll take an example. So let's say you just have one credit card that you opened 10 years ago. And then 10 years later, you think about applying for a new credit card, your credit score is healthy, you apply for a new credit card. Now suddenly, the average age of your credit history is the 10 years that you've had the account open for. But you now just have 2 credit cards, so your average age goes down to 5 from the 10 it was at. Whereas let's say if you've had 2 credit cards that you've opened every single year, by the 10th year, you probably have 20 credit cards, so adding the 21st is not going to impact your average age as much. Let's move on to the 4th component, which is the credit mix, and that constitutes 10% of your credit score. This speaks to the different type of credit lines that you have available in your financial journey. So this could be a mix of credit cards, home mortgages, auto loans, student loans, etc. Generally speaking, a good diverse mix of credit accounts is a good sign to credit bureaus that you can handle a multitude of different accounts. Bearing in mind the other principles that we discussed, like paying on time, paying in full, as long as we're doing all of that, having different types of credit is a good indicator to the bureaus. Also bear in mind that if you pay off, let's say your student loan or your auto loan, and that drops off your credit report, that's going to have a downward impact on your credit score. That isn't necessarily a bad thing long term, but something to keep in mind. I also wouldn't worry about how you go about building a credit mix that's healthy. This will happen over time if you have good financial practices. The last component of your credit score, number 5, is going to be new credit. And that's 10% of your credit score. So this is the number of new credit lines that you've opened. The hard inquiries that come from applying for a new line of credit can stay on your credit report for up to 2 years. And there will be a temporary downfall in your credit score as a result of that, but this picks back up. So there's a misconception here that applying for a lot of credit cards is troublesome for your credit score and impacts your credit score negatively. That's not entirely true. Obviously, you have to be strategic about what credit cards you're applying at what point in time and if each of those have a purpose. But if you have a strategy where you're spacing out your applications and you have healthy financial habits like paying off your credit card debt, in full and on time, and not carrying heavy balances during the statement closing dates, opening new accounts will only have the temporary ding. Let's go back to the example of the 5 credit cards. So initially, if we think about the 5 credit cards that each had $10,000 of credit limit, now you are adding a 6th credit card that might also have a $10,000 limit. So now the denominator for the credit utilization math, which is 30% of your credit score, suddenly goes from $50,000 to $60,000, bringing your credit utilization down across the board, keeping in mind that most of your expenses stay the same period over period. And that has a higher impact on your credit score than the new inquiry that you just had on your credit report. So long term, more than a few credit cards actually doesn't negatively impact you. It does impact you short term. The other thing to keep in mind is if you're applying for a home mortgage, not having too many hard inquiries on your credit report, I would say at least 6 months before you're going to apply for the mortgage, is good practice. I've been guilty of not doing this in my own mortgage applications, where in some cases I've had to deal with potentially paying higher interest rates just because I had a credit card that I had applied to before applying for the mortgage within the 6-month window. So please keep that in mind as you're going on your credit card journey. Now, if this video is helpful to you, consider liking and subscribing. And as always, I'll see you in the next one. Peace.